I'm Jared Pratt, CEO of Granite Peak Associates.
I'm Heather Piazza, Tax Manager at Granite Peak.
We're always looking to highlight case studies, real situations of clients that saved a ton of tax dollars. And one that came up recently, and we see it quite a lot with practice owners that have either bought or started a practice. They buy the related real estate, and now we can, on the real estate side, we can introduce them to a cost segregation company to come in, perform an analysis on that building, and save them a ton of tax dollars.
Essentially what this company does is they come in, they have a site visit, and they put a dollar value to every item of the building. And what that does is it puts it into different buckets. So we have the 5-year bucket, we have 7-year, we have 15-year, we have 39-year buckets. So rather than take the cost of the building and deduct it over 39 years, it allows us to come in and accelerate those deductions in the early years, which allows us to save you tax dollars in today's dollars when cash flow might be tight or you're just starting up the practice versus waiting that full time period to actually recognize those expenses.
Yeah, so you find any cost seg company you speak to, they'll generally say they're trying to return at least 20 to 30% of what that cost outlay was in year one. So you buy $1 million building. They're confident that they can come in and identify 20 to 30% of that purchase price as year one deductible expense. So we're talking on $1 million purchase of real estate, $200,000, $300,000 of tax deduction. It's substantial dollars, it's meaningful deduction. It allows us to do some great planning from you. You keep the cash in your pocket. Let's kick that tax can down the road and worry about that in years 3 and beyond of practice ownership.